I think one way to think is step back. Think about the entire financial industry, everything from like private equity to the big banks to venture capital, et cetera. And if you pull a dollar at random from that pool, right? So it's quite likely that that dollar is going to come from, a large bank or private equity or whatever. And like, what is their goal? Well, let me tell you, it's not innovation. It's just not, it's predictable returns, it's arbitrage, it's shorts, it's all of this other stuff. And like kind of the top of the value chain is this cohort of people that they're not interested in building companies and backing founders. Like, it's funny. I mean, I remember speaking with a private equity person. I'm like, I was just talking to myself. I'm like, we're just having a conversation, idle conversation. Like, if there's a public company and like the founder's still running it, I'm bullish just because it's the founders, and founders can weather transitions and they can weather market transformations. Like, look at Reed Hastings, look at Jensen, like founders are amazing. And this PE guy, it was like I was speaking Greek. He's like, why do you care if the founder's running it? I'm like, it's the fucking founder, man. This is the person that made the magic to begin with. It's the person that has the credibility. Like, that's everything. And so my point is here is, I want a future where if you pull a dollar of random from finance, that dollar is given by somebody that believes innovation is good and believes in founding teams and believes that you can continue to scale capital deployment far beyond just like Series C or whatever.
Can I dive in and kind of pose some alternatives, which is like, okay, if we think about financing a company seed to, post IPO, one thing I don't like about having multi-stage investors where I'm on boards is the founders continuously having to sell. They don't bring the truth to the board with Martine because they want you to lead the next round as well. And so they continuously have to bring this veil of truth because they're selling for the next round whilst you're already in. How do you think about that and respond to that as a problem that you face?
Well, I think that would indicate a really broken relationship between the board member and the founder. So in all of these cases with multi-stages, the actual investor and board member is aligned to a fund. And so, for example, if you graduate from seed to venture, venture to growth, it's an entirely different team that's making a decision. And so the board member is very, very aligned with the founder when it comes to the next raise. And so, for example, I focus primarily on seeds A's and B's. Sometimes our growth fund decides that it does the deal, and I've been there pitching them too. So like, I'm very much aligned, because I think it's great when Andreessen goes in. And so I think a situation where the company is reliant on one person to make all of the decisions is not healthy. But certainly to have a partnership where they can have access to pools of capital to the life of the company is positive.
I get that, and I like that in terms of the segmented decision-making across vehicles. The next question that I have is, like, if we think about returns, we both know that small funds generate great returns. When you see this explosion of capital within these scale-up vehicles and going, as you said, through even to public markets, do you not worry that we're going to see the denigration of venture returns to PE-like returns with the maturation of the industry?
Well, I think this is just a bundling question, which is I think you create funds for different risk buckets and you provide LPs exposure to that. Like debt will never get the same return as equity, and early stage will never get the same as late stage. And so you've got just different variances on all of these. So the way, it's interesting, this is probably why, I would be a horrible financial investor, just horrible. It's like, I don't even really care strictly about thinking on returns. Like, that's not what I maximize. I mean, here's the way that I view it, which is very simple, which is, listen, I strongly believe technology is a good. I think it solves problems. I think it adds value. I think it creates productivity. I mean, I think if you look at any graph on kind of like human betterment, which is like, infant mortality or how long we live or, the number of diseases we have or whatever. I mean, this is just correlated with technical advancement. So I think, technology is a general good. Anybody that's building, technology that weathers the Darwinistic ecosystem of economics is going to be adding value. And so I view this asset class as investing in an index of the top innovators, in the world, and that's a very productive asset. And so my mental model is for anybody that wants exposure to the top software innovators in the world that are adding value, I want to provide an opportunity for them to have exposure to that. And I want to help those set of top innovators. Now, what happens specifically about the returns is a question on macro and all sorts of other stuff. But I guarantee a lot of value is going to accrue there. And historically, a ton of value is going to accrue there, right? And so I like to think at much more of an index across innovation and much less specifically about, like you give me $1, I'm going to kind of make this $1 go up or down by exploiting every aspect that I can of a market.